Picture this. It is 3 hours past midnight in Lower Manhattan. The date is February 7th, 2026. While the algorithms are asleep, a secure transmission hits the clearing servers of the COMEX. It is not a buy order. It is not a sell order. It is a standing delivery notice. A single, unidentified entity, we will call them the mystery whale, has just demanded the physical delivery of 5,000 contracts. That is 25 million ounces of silver, not paper certificates, not leased metal. They want 25 million ounces of physical bars loaded onto armored trucks and removed from the vault. The spot price on your screen might say $28. That is a lie. The price to actually get your hands on this metal just spiked to $40. The spread is blown out. The illusion of infinite paper supply has finally shattered against the hard wall of physical reality. Welcome back to Boring Currency. We do not look at the charts the news shows you. We look at the loading docks where the metal leaves. We are the silent observers of the greatest wealth transfer in history. I need you to stop what you are doing. Turn off the television. Close your other browser tabs. What I am about to show you is a mathematical certainty, not a prediction. Focus on the data. Before we dissect the corpse of this market, I need to know who is in the room with us. Go to the comments section right now and tell me which city you are watching this collapse from. Are you in London, Singapore, or New York? Let me know below. Let us open the hood of the engine and look at the mechanic failure. To the untrained eye, the market looks normal. The candles on the chart are moving up and down. But if you look at the plumbing, the pipes are bursting. We need to talk about a phenomenon called backwardation. In a healthy market, the future price of silver should always be higher than the spot price today. This is basic economics. It costs money to store metal, to insure it, and to secure it. Therefore, silver delivered next month should cost more than silver delivered today. That is the cost of carry. But right now, we are seeing the exact opposite. The spot price is trading higher than the futures contract. This is a scream for help from the physical market. It means that the industry is desperate for metal right now. They do not want a promise of silver in March. They need the bars on the factory floor today. When backwardation becomes permanent, it is the death knell of a fiat currency system. It is the market telling you that the paper promise is worth less than the commodity itself. Now, let us examine the crime scene at the COMEX vaults. You must understand the difference between two very specific categories of inventory. First, there is eligible silver, and second, there is registered silver. The news media will often combine these two numbers to tell you that there is plenty of silver. That is a deception. Eligible silver is metal that sits in the vault, but it is not for sale. It belongs to private investors, family offices, or entities that are simply paying the warehouse for storage. It has nothing to do with the available supply. It is like looking at the cars parked in your neighbor's driveway and assuming they are for sale. They are not. The only number that matters is registered silver. This is the inventory that has a warrant attached to it. This is the metal that is available to be delivered against a futures contract. At the beginning of 2021, there were 150 million ounces in the registered category. As of this morning, that number has bled down to just 30 million ounces. Think about that number, 30 million ounces. That sounds like a lot until you realize that the daily trading volume on the COMEX is often 500 million ounces. The entire available inventory of the world's primary pricing mechanism can be wiped out in a single morning of aggressive trading, if the holders stand for delivery. This brings us to the leverage ratio. We call this the paper to silver ratio. For every single ounce of physical silver sitting in the registered category, there are currently 356 paper claims trading against it. Let me repeat that so it sinks in. 356 to 1. Imagine a game of musical chairs with 356 people and only one chair. As long as the music plays and as long as everyone is happy trading their seat tickets, the game continues. The price of the ticket goes up and down. Everyone feels wealthy. But the moment the music stops, the moment confidence evaporates, 355 people are going to be left with absolutely nothing. The mystery whale we identified in Part A knows this. They are not looking for a profit in dollars. They are looking to secure the chair. By demanding delivery of 25 million ounces, they are effectively removing nearly 80% of the remaining float in a single transaction. Usually, when a large entity tries to do this, the bullion banks, the market makers like JP Morgan or HSBC, will step in. They will offer a cash settlement. They will call the whale and say we cannot deliver the metal, but here is a premium of $2 per ounce to settle this in cash. Most hedge funds take the free money. They take the bribe. But this time, the phone is ringing and nobody is answering. The whale has rejected the cash settlement. This is what we call breaking the arbitrage. When the arbitrage breaks, the mechanism of price suppression fails. The banks are now in a scramble. We are seeing reports of emergency leases from the London Bullion Market Association. They are trying to fly 400-ounce bars from London vaults to New York to meet the delivery requirements before the deadline. This is why the lease rates for silver have just spiked to negative territory. Banks are paying people to lend them silver. This is not a market functioning normally. This is a liquidity crisis masquerading as a correction. The scary part is not that the price is crashing. The scary part is that the price is irrelevant. You cannot buy physical silver at the spot price anymore. Try it. Call a dealer. The premium is 40%, 50% over spot. The paper price and the physical price have divorced. We are witnessing the bifurcation of the market. One price for the illusion and another price for the reality. If this 25 million ounce delivery goes through, the registered vault will be effectively empty. We will hit what is known as force majeure. The exchange will declare that due to circumstances beyond their control, they can only settle contracts in cash. At that moment, the paper contract becomes worthless for industrial acquisition. Apple, Tesla, Samsung, they cannot build electronics with a cash settlement. They need silver. And if the COMEX cannot provide it, they will bypass the exchange entirely and go direct to the miners. That is when the true price discovery begins. And that is why they are terrified. To understand where we are going, we must first look at the tombstones of those who tried this before. History does not repeat itself, but it often rhymes. We are currently rhyming with the year 1980. In the late 70s, two oil tycoons from Texas, the Hunt brothers, looked at the inflation of the United States dollar and decided it was garbage. They began to accumulate physical silver. They did not trust the government printing press. By January of 1980, they controlled nearly 100 million ounces of silver. Their buying pressure drove the price from $6 all the way up to $50 an ounce. The entire financial establishment in New York was on the brink of insolvency. The short sellers, who were the big banks, were losing billions. So, what did the establishment do? They changed the rules in the middle of the game. The regulators at the COMEX implemented a rule called liquidation only. This meant that traders could only sell their contracts. They were forbidden from buying new ones. Imagine going to a grocery store where you are allowed to return food. But you are forbidden from buying it. The price, of course, crashed. The Hunt brothers were destroyed because they had bought their silver on margin. They used borrowed money. When the price dropped, they faced a margin call they could not meet. Fast forward to February 2026. The mystery whale demanding delivery today has studied the Hunt brothers. They learned the lesson. This entity is not using margin. They are not borrowing money from the very banks they are fighting. They are paying cash. You cannot margin call a buyer who has paid in full. The trap that killed the Hunt brothers is useless against a cash buyer. The COMEX has no weapon left in its arsenal except to default. There is another ghost we must summon. The year 1997. Warren Buffett, the Oracle of Omaha, quietly bought 129 million ounces of silver. He understood the fundamental value, but Buffett was part of the establishment. He took delivery in London. He spread his purchases out so he would not break the market. He was gentle. The entity we are tracking today is not gentle. This is a hostile takeover of the physical inventory, and this hostility is coming from a specific direction on the compass. East. For the last 3 decades, the flow of precious metals has been one way. From the vaults of London and New York, moving east to Shanghai, Mumbai, and Singapore. The Shanghai Gold Exchange consistently trades at a premium compared to the COMEX. This price difference creates a vacuum cleaner effect. Smart arbitrage traders are buying physical bars in the West, putting them on planes, and selling them in the East for a risk-free profit. This has been draining the Western vaults slowly for years. But now, the drain has become a torrent. The nations of the BRICS alliance, Brazil, Russia, India, China, and South Africa, have stopped trusting Western debt. They are no longer recycling their trade surpluses into United States Treasury bonds. Instead, they are converting their excess dollars into hard assets. They are buying gold and silver. This is not just a trade. This is a geopolitical divorce. The West is left holding paper derivatives and digital promises, while the East is accumulating the physical collateral that powers modern industry. When the vaults in New York finally hit zero, it will mark the end of the era where the price of silver is determined by paper traders. The pricing power will shift to Shanghai. And when that happens, the price will not double. It will revalue to a level that balances the physical supply with the physical demand. We are watching the last stand of the paper market. Let us move away from the flickering screens of the derivatives market and step onto the factory floor. This is where the paper narratives die and the laws of physics take over. Most people look at silver and see a second-tier monetary metal. They see the poor man's gold. That is a fatal error in judgment. Silver is not just money, it is a strategic element. In the periodic table of elements, it holds the title for the highest electrical conductivity and the highest thermal conductivity of any metal known to man. You can print more dollars, you can print more yen, you can even mine more cryptocurrency code, but you cannot print an element. We are currently witnessing a phenomenon I call the unobtainium factor. This is when a material becomes so critical to the functioning of society that its price becomes irrelevant to the buyer. They simply must have it. Let us look at the energy transition, the Green New Deal, the net zero targets. All of these political slogans are effectively purchase orders for silver. In the year 2024, the solar industry consumed roughly 190 million ounces of silver. By the end of 2026, projected demand is expected to shatter 300 million ounces. That is nearly 30% of the entire global mining supply consumed by a single industry. The engineers tried to thrift it out. They tried to use copper. They tried to use aluminum. But physics is stubborn. When you replace silver with copper in a solar panel, the efficiency drops. The panel degrades faster. In a world desperate for energy efficiency, second best is not an option. Newer technologies like TOPCon and heterojunction cells actually require more silver per panel, not less. We are building a solar infrastructure that is stripping the Earth of this metal at a rate that is mathematically unsustainable. Then there is the artificial intelligence revolution. Everyone is talking about the chips, everyone is talking about the data centers, but nobody is asking what connects the chips to the motherboards. Every single server farm, every electric vehicle, every 5G tower, and every smart device requires silver contacts. It is the glue that holds the digital world together. If you remove silver from the equation, the screen you are watching this on goes black. The internet stops. The modern world ceases to function. But the most terrifying aspect of this demand is not commercial. It is military. The Department of Defense does not publish its silver consumption numbers. That is classified. But we know this. You cannot build a Tomahawk cruise missile without silver. You cannot build a torpedo, a jet fighter, or a satellite without silver zinc batteries and silver-coated bearings. In a time of rising geopolitical tension, silver is a matter of national security. When the United States government realizes that the COMEX vaults are empty, do you think they will let the remaining metal flow to China or India? No. They will declare it a strategic asset. They will nationalize the supply. Now, let us look at the other side of the ledger, the supply cliff. While demand is going parabolic, supply is falling off a cliff. The two largest producers in the world are Mexico and Peru. Both are facing massive headwinds. Ore grades are collapsing. In the year 2016, a miner might have extracted 12 ounces of silver from a ton of rock. Today, they are lucky to get 4 ounces. We have picked the low-hanging fruit. We are now digging deeper, for less metal at a higher cost. Furthermore, 70% of all silver comes as a byproduct. It is accidental. Miners dig for copper, lead, and zinc, and they find a little bit of silver on the side. This is crucial to understand. It means the supply of silver is inelastic. If the price of silver goes to $100 an ounce, the miners cannot simply turn a dial and produce more. They are mining copper. If the global economy slows down and demand for copper drops, they will mine less copper. And inadvertently, they will produce less silver. We are entering a perfect storm. We have exponential demand from industries that are price inelastic. A solar panel manufacturer does not care if silver is $20 or $50. It is a tiny fraction of their total cost, but they cannot ship the product without it. They will pay any price. On the other hand, we have a supply chain that is broken, depleted, and politically unstable. We have been filling this gap between supply and demand by draining the above-ground stockpiles. We have been eating our seed corn. For the last 4 consecutive years, the market has been in a structural deficit. We have consumed hundreds of millions of ounces more than we mined. Where did that extra metal come from? It came from the vaults in London and New York. It came from the very stockpiles that are now flashing red. The dealers know this. Try to buy a monster box of Silver Eagles today. You will wait 4 weeks for delivery. The premiums are stuck at 40% over the spot price. This is the physical market screaming that there is no metal left. We are running on fumes. And the mystery whale, taking delivery of 25 million ounces, has just lit a match. We have now reached the final chapter of this investigation. This is where the data ends and the survival strategy begins. If you have followed the evidence from the beginning, you now understand that the COMEX is not a market. It is a suppression mechanism. It is a crime scene where the price is manipulated to protect the fiat currency system. But the mystery whale has just kicked down the door, and the police are nowhere to be found. We are entering what I call the liquidity trap. Most people assume that when the price of silver explodes, they will simply log into their brokerage account and click buy. They assume the market will always be open. They assume there will always be a seller on the other side of the trade. That is a dangerous assumption. When the physical inventory reaches zero, the market does not just go up, it breaks. It goes what we call no offer. Imagine walking into a dealership to buy a car and there are no cars. You offer 10% more. They say no. You offer 50% more. They say no. The price is irrelevant because the product does not exist. This is the scenario we are facing in the silver market. When the 25 million ounces leave the vault in New York, the remaining liquidity will evaporate within hours. The dealers will pull their inventory from their websites. The mints will stop taking orders. The entire supply chain will freeze. So, let us game out the 2 most likely scenarios that will unfold in the next few weeks. Scenario A is what I call the force majeure event. The COMEX will declare that they cannot meet the delivery requirements due to extraordinary market conditions. They will invoke the emergency clauses in the contract. They will force the remaining contract holders to settle in cash. They will say, "We cannot give you the silver, but here's the cash equivalent at the last traded price." This is the ultimate default. It is the moment the paper market admits it is a fraud. If you are holding a paper contract or an unallocated account, or shares in a generic ETF like SLV, you will be paid out in depreciating dollars. You will get your money back, but you will not get the metal. And by the time you get that money, the real price of physical silver will be double or triple what you were paid. You will be made whole in nominal terms, but you will be wiped out in purchasing power. Scenario B is the revaluation event. This is the more chaotic outcome. The price on the screen disconnects from reality. We will see a bifurcation of the price. On your television, the spot price might show $30, but in the real world, the price to actually buy a 1-ounce coin will be $100 or more. The premium will explode to 300%. We saw a preview of this in 2008. We saw it again in 2020, but this time, it will be permanent. The paper price will become a vestigial organ, a relic of a dead system, while the physical price discovers its true value based on scarcity. So, what is the strategy? How do you position yourself before the door closes? First, you must understand counterparty risk. If you can hold it in your hand, you have no counterparty risk. If you have to log into a website to see it, someone else owns it and you just have a claim on it. In a crisis, claims are denied. Possession is 9/10 of the law. Second, avoid the leverage. Do not try to trade this with options. Do not try to be the Hunt brothers. The volatility will be violent. The exchanges will raise margin requirements to flush you out. They will change the rules to ensure the house wins. The only way to win this game is to not play by their rules. Buy the physical asset, take delivery, and remove it from their system. Third, watch the ratio. The gold to silver ratio is currently hovering near 85 to 1. Historically, this ratio reverts to 15 to 1. This means silver is mathematically the most undervalued asset on the planet relative to gold. When the reversion happens, the wealth transfer will be generational. The window of opportunity is closing. The mystery whale has made their move. The clock is ticking on the 25 million ounces. Once those trucks leave the loading dock, the panic will begin. I am not a financial advisor. I am a forensic analyst. I look at the blood spatter on the charts and tell you what happened. But today, I am telling you what is going to happen. Ascens, do not wait for the news to tell you there is a shortage. By the time they report it, the shelves will be bare. Do not wait for the price to confirm your bias. By the time the price moves, you will be priced out. The system is designed to keep you asleep until it is too late. Waking up is your responsibility. If you want to know which dealers still have verifiable inventory as of this morning, and which mints are already back ordered, I have compiled a full dossier. It includes the specific list of bullion dealers that I personally trust and use. Click the link in the description below to access the report. Do not trust my words. Trust the weight of the metal in your hand. If you do not hold it, you do not own it.